Imagine you're driving through the most expensive, exclusive neighborhood in your city,
Okay, I'm picturing it.
and you see this massive, gorgeous mansion. It's like a legacy estate, the kind of place that defines the whole area.
Right, the anchor of the neighborhood.
Exactly. But out front, there's a for sale sign. And the asking price
Hmm.
is, it's practically what you'd pay for a small condo down the street.
Oh, wow. Yeah, that's suspicious.
Right. Your first reaction isn't to just pull out your checkbook. Your first reaction is to think, wait, what is wrong with the foundation? Is the roof caving in? Or, I don't know, is it haunted?
Yeah, because when the price of a premium asset drops that drastically, human nature just assumes there's some fatal flaw hidden inside.
Totally.
We instinctively look for the crack in the foundation because, markets are rarely that inefficient without a very specific reason.
Well, welcome to the deep dive. Today, our mission is to step into the shoes of a senior equity research analyst. We're building a comprehensive, start-to-finish 2026 investment thesis for one of the most famous tech giants in the world, Salesforce.
Because right now, Salesforce is absolutely that wildly discounted mansion.
It really is. For context, this is a company that hit a 52-week high of over $296, and today, it's tumbled nearly 26%.
Yeah, it's trading right in that $192 to $199 range.
Which is just a dramatic repricing, especially for a company that practically invented the modern software as a service or SaaS business model.
It really is. And to understand if that foundation is actually cracked, we have to strip away the market panic. We need to look at the cold, hard data driving this sell-off.
Exactly. So to figure out if this is the start of a, software apocalypse or maybe a generational buying opportunity, we've got a massive stack of sources today.
The fun stuff.
Oh, yeah. We're tearing into their latest SEC 8K filings, earnings call transcripts, S&P Global credit rating reports, analyst forecasts from Wall Street.
Plus some really interesting financial analysis from 247 Wall Street, The Motley Fool, and Guru Focus.
Right. So, okay, let's unpack this. We have a company with record margins, aggressive AI rollouts, and yet the stock is crashing. Before we can even look at the future of Salesforce, we really have to look at how the market is pricing it today.
We do, because ultimately, a stock's price is just a reflection of what the market is willing to pay for its future earnings. And right now, the market is pricing Salesforce like a distressed industrial asset.
Not a cloud pioneer.
Exactly, not a cloud pioneer at all.
The valuation metrics we pulled from the sources are honestly staggering.
Right.
Right now, Salesforce's price-to-earnings ratio, the PE ratio, is sitting around 25.1.
Which sounds reasonable until you look at the history.
Right. To put that in perspective for you, its historical average PE over the last 3 years is 132.06.
It's a massive contraction.
And it gets crazier. If we look at the forward PE, what the market expects it to earn over the next 12 months, it's hovering around 14.62. It's like finding a designer jacket at a thrift store. It looks like a steal, but you're constantly checking the lining for a huge tear.
Yeah, and think about what that forward PE of 14 actually implies.
Yeah.
You really only see multiples like that attached to mature, slow-growth legacy banks.
Or utility companies.
Right. It basically says the market believes Salesforce's high-growth days are permanently over. But when you break down their actual cash generation machine, that whole narrative gets really complicated.
So let's look at the Q4 fiscal year 2026 numbers.
Yeah.
They pulled in $11.2 billion in revenue for the quarter.
Which was a bet, right?
Yeah, beating expectations with an earnings per share of $3.81. And for the full year, they hit $41.5 billion in revenue, which is up 10%. But the real story here is the cash.
Always followed cash.
Exactly. They generated a massive $14.4 billion base of free cash flow.
And we should probably define free cash flow here because it's essentially the lifeblood of our whole investment thesis today.
Yeah, break that down for us.
So this isn't just accounting profit. This is the hard cash left over after the company has paid all its operating expenses and all its capital expenditures.
So like the servers, the real estate.
Right. Everything needed to keep the lights on. They are operating with a free cash flow yield of roughly 8%. In fact, they returned over $14 billion to shareholders in FY 2026.
Wait, $14 billion? That's almost all of it.
Yeah, it represents basically 99% of its free cash flow.
That is insane. So, meaning for every dollar you invest in the stock at its current price, the company is generating roughly 8 cents in pure, unencumbered cash.
Exactly. So let's take that 14.4 billion cash flow and run a quick 10-year discounted cash flow analysis, a DCF.
Standard equity research practice.
Right. The goal of a DCF is just to estimate the intrinsic value of a company based on the cash it'll generate in the future, discounted back to today's dollars.
Okay, I love this. Let's run the math. If we assume a really conservative revenue growth expectation of, say, just 9% over the next decade.
Which is lower than their historical average.
Way lower. And we use a standard 10% discount rate, the WACC, to account for the time value of money and market risk.
And we also have to apply a terminal growth rate. Let's use 2.5%, just assuming they eventually grow at the pace of the broader economy.
So what does the model spit out?
If you plug all of that in, starting from that $14.4 billion base, the intrinsic value per share comes out significantly higher than the $194 it's trading at today.
The math literally screams that it's undervalued.
It does.
Which brings us back to the core mystery here. For you listening, just think about your own investment portfolio. If you have a company generating that much cash and trading at a historic discount according to standard DCF models, why is the market treating it like a dying legacy brand?
Well, the low valuation hasn't gone unnoticed by Salesforce management either. They see the same DCF models we do.
Oh, for sure.
But instead of just communicating a better growth story, it's led them to make a massive and honestly controversial financial maneuver.
Which is terrifying the credit rating agencies. So let's dig into this SEC 8K filing from March 2026. Management essentially looked at the market and said, look, if you won't buy our stock, we will.
Right.
They authorized a jaw-dropping $50 billion share repurchase program. And they kicked it off with a $25 billion accelerated share repurchase, or ASR.
Which is an incredibly aggressive tactic.
Yeah, explain how an ASR works versus a normal buyback.
So an ASR is a very specific mechanism. Instead of quietly buying a few thousand shares on the open market every day over months or years, a company hands billions of dollars to an investment bank and says, give us millions of our shares immediately.
Just a massive, sudden shock to the share count.
Exactly. It's designed to artificially boost the earnings per share.
But the twist here, and this is the part that is blowing my mind, is how they're paying for it. They aren't just using that $14.4 billion in free cash flow.
No, they're not.
They are funding this $25 billion buyback by selling $25 billion in senior notes, debt. They are taking on long-term debt to buy back short-term equity.
And if we connect this to the bigger picture, we really need to look at the terms of that debt. They are issuing notes maturing as far out as 2066.
Wait, 2066?
Yes.
They're taking on 40-year debt, with interest rates between 4.5% and 6.7%. I mean, they also executed a new $6 billion 5-year term loan just to refinance existing debt.
It's wild.
It's a bit like taking out a 40-year mortgage just to buy new furniture for your living room.
That is the perfect analogy.
Like, sure, your house looks great today, and you feel super comfortable right now, but you've added serious long-term leverage to your household just to fund an immediate cosmetic upgrade.
And that introduces a brand new risk profile.
Right.
Management might feel their balance sheet is under-leveraged right now, but the ratings agencies disagree. S&P Global just revised Salesforce's credit outlook to negative.
Because of this specific move.
Absolutely, because while their current debt to EBITDA is objectively tiny at roughly 0.6 times.
And real quick, EBITDA is earnings before interest, taxes, depreciation, and amortization. Basically a proxy for raw operational profitability.
Right.
Owing only 0.6 times your annual EBITDA is usually incredibly safe.
Right. The current snapshot is totally safe. But credit agencies grade on trajectory. S&P has a strict downgrade trigger set at 2 times debt to EBITDA.
Okay.
And they're warning that this aggressive debt-funded buyback strategy could easily push Salesforce past that downgrade trigger within the next 1 to 2 years.
So management feels they're under-leveraged, but S&P is saying, hold on, you're moving too fast. It feels like they're transitioning from a pure technology growth engine into like a financial engineering firm.
And that is exactly why the market is forcing Salesforce to buy its own stock to prop up the price.
Right.
It's because of the looming fear of the 2026 software apocalypse, or what everyone's calling the Syspocalypse.
Let's explain this fear. Because Wall Street is absolutely terrified that AI is going to cannibalize traditional SaaS revenue models.
Which are historically seat-based.
Right. Meaning Salesforce charges a subscription fee for every human user.
Yeah.
You hire a human sales rep, you buy a Salesforce seat. But if we're moving into this agentic enterprise era,
Where AI agents do the actual work.
exactly, if AI agents do the work, companies need fewer human seats, which means fewer Salesforce licenses.
And we're already seeing that fear reflected in the forward guidance. Salesforce's FY 2027 revenue guidance came in at $45.8 million to $46.2 billion.
Which is only, what, 10 to 11% growth?
Exactly. And that completely missed Wall Street's expectations, despite them having record margins.
It's a huge shift from the days of 20 to 30% annual growth.
And we also have to evaluate the competitive landscape. Salesforce is facing a massive pincer movement threat.
The pincer threat, yes, from Microsoft and Oracle.
Right. On one side, you have Microsoft pushing its Dynamics 365 CRM, which is deeply integrated with their AI Copilot across the whole Office suite. That's attacking the workflow layer.
And then on the other side, you have Oracle integrating AI directly into the fundamental database layer. So Salesforce is trapped in the middle.
But, and this is a big but, we have to look at Analyst Beal's framework from 247 Wall Street because not all software moats are equally vulnerable.
I love this framework. He contrasts Salesforce with Adobe, right?
Yes. So Beal separates software into two categories, the road and the toll booth.
Okay, so Adobe is the road.
Exactly. Adobe is embedded in creative workflows. A designer uses Photoshop because it's the standard road they drive on. But if a faster, cheaper AI image generator comes along, that designer can just switch software in an afternoon.
They just choose to drive on a different road.
Right, they're vulnerable to new tools. Salesforce, however, is the toll booth. They aren't just a workflow, they're embedded in transaction data.
Oh, that makes so much sense. Because replacing Salesforce doesn't just mean learning a new interface. It means an enterprise would have to abandon years, maybe decades, of irreplaceable institutional transaction history.
The switching costs are astronomically high. You can't bypass the toll booth when your entire company's memory is stored inside it.
And the data actually backs up this bull case for their AI moat. Their new autonomous AI platform, Agentforce, is doing incredibly well. It already hit an $800 million annual recurring revenue, or ARR, in FY 2026.
Which is up 169%.
Yeah. They closed 29,000 Agentforce deals in just 15 months. But here's the best part. Over 60% of Q4 Agentforce and Data Cloud bookings came from their existing customers.
You're upselling the captured audience.
Exactly. And they're making that ecosystem even stickier. We have to talk about the Informatica acquisition.
Oh, the $8 billion acquisition they completed in late 2025.
Right. How does that fit into the toll booth?
It's the synergy that makes the agentic enterprise possible. That deal alone contributed nearly $400 million in Q4 revenue.
Wow. Just in Q4.
Just in Q4, because an autonomous AI agent is completely useless if it hallucinates or pulls from messy corporate data. Informatica creates a unified, trusted data layer.
It cleans up the mess.
Exactly. It ensures the AI actually works safely, which locks the customer into the Salesforce ecosystem even deeper.
Okay, so let's pause and summarize here. The fundamentals actually look decent. The AI mode is way deeper than expected. They've got record cash flow. Why is the stock still stuck under $200?
Because of exogenous shocks and internal friction.
The stuff outside the spreadsheet.
Right. Let's look at the macro environment first. The Guru Focus piece highlights a severe macro shock playing out in the Middle East right now.
Yeah, with Iran's supreme leader being wounded.
Exactly. Analysts at RBC are warning this conflict could push oil prices above their 2022 highs.
And how does that impact a software company?
It causes a capital rotation. When geopolitical instability spikes and energy prices soar, data centers get incredibly expensive to run. So institutional capital rotates out of high multiple bits-based software stocks and moves into atoms-based physical economy assets.
So money is moving from SaaS to the physical economy.
Exactly.
But it's not just the macro stuff, right? There's serious internal friction at Salesforce right now.
There is. And when you're trying to execute a massive pivot to an agentic enterprise, you need flawless execution.
Which they are struggling with. Now, before we get into this next part, I need to state a very explicit disclaimer for our listeners.
Important to do.
We are looking at these events strictly through the lens of an equity researcher analyzing company stability. We aren't taking any political sides here, just reporting what happened in the source material and how it impacts operational risk.
Perfectly said.
So let's look at the February 2026 company kickoff. During the event, CEO Mark Benioff made jokes about U.S. immigration and customs enforcement IC agents being in the back of the room.
which obviously did not land well with the staff.
Not at all.
Yeah.
And alongside this, it leaped that Salesforce had pitched its new Agentforce infrastructure to ICE.
And from an operational standpoint, this sparked a massive internal employee backlash on Slack.
Oh, the Slack channels apparently completely melted down. It required an emergency town hall by President Robin Washington just to try and calm the tensions.
And you have to remember, this is a workforce that is already on edge.
Right, the layoffs.
Yeah. The company just executed a quiet layoff of 1,000 employees across marketing and AI roles, and that follows a massive 4,000-person cut to their customer service teams in 2025.
So you combine culture clashes, executive leaks, and workforce reductions. It adds a ton of operational risk right when the company needs to be perfectly aligned to build this AI future.
It makes attracting and retaining elite AI talent exponentially harder.
Okay, so we really have all the pieces of our investment thesis on the table now. The historically low valuation, the massive debt-funded buyback, the transaction data moat, and this macro and internal turbulence.
Yeah.
What is the final verdict from the analyst community?
Well, according to Wall Street's then, the consensus is a moderate buy.
Yeah, out of 33 analysts, 17 rated a strong buy and 8 rated a buy.
And what's the price target looking like?
The mean 12-month price target is sitting around $282.
Which is massive upside from current levels.
Yeah, over 38% upside. Prominent investors like Dan Ives are even calling this software sell-off a generational buy.
So if we synthesize all of this, let's look at the risk-to-reward ratio. The bear side says leverage is rising to dangerous levels with that 40-year debt, growth is slowing to just 10%, and macro oil shocks are spooking the market away from SaaS.
Not to mention the internal culture issues.
Right. But the bull side. The bull side says this is a highly profitable cash machine with an incredibly sticky transaction data moat. It's trading at a steep discount to its historical PE, and it has massive built-in shareholder returns with that $50 billion buyback and a recently increased dividend.
So what does this all mean for you listening? Think about your own strategy. Are you a value investor looking for an 8% free cash flow yield? Or are you a growth investor who is terrified of the AI transition and the debt leverage?
It's the ultimate question for the sector right now, and it leaves us with one final kind of provocative thought to ponder.
Lay it on us.
When a pioneering software company starts issuing 40-year debt just to buy back its own stock, we have to ask, is the era of limitless SaaS innovation officially over?
Wow.
Are we now entering an era where tech giants behave more like traditional legacy banks, relying on financial engineering rather than pure technological disruption to drive shareholder value?
That is a fascinating way to look at it. The transition from pure tech to financial engineering. Well, whatever side of the trade you land on, thank you so much for joining us on this deep dive. Keep questioning the numbers behind the headlines, and we will catch you on the next one.